Hello and welcome to today's Premium Account Market Update for March 2020. Presented today myself, Leon Hind, Managing Director of Investor Signals. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. The topics that we're covering today, we're looking at the macro update driving global equities. We roll through the ASX top 50 stocks with a focus on FY20 earnings. We look at the technical trends. We identify our current portfolio allocations and conclude with a short-term market outlook. The Investor Signals Model Portfolio Service, we focus on two classes of securities, ASX top 100 shares and in the US S&P top 100 shares. If we follow the performance of the algorithm model across the last 10 years, it's similar to the data up on screen, but the table shows the 5-year average, which is tracking at around 17% per annum for Australian equities, 15% for US. Last year, in 2019, you can see there the performance was well above average, and that's partly a reflection of the sell-off that we had at the end of 2018 and then 2019 starting from such a low point and having a strong performance in the equity markets. But in saying that, the model portfolios outperformed the index by a substantial amount. So as we increasingly look to focus more of our decision making around the algorithm model supported by the backtesting that we've looked at over the last 10 years, we're now able to integrate it more into the business model. So what we are offering clients is a global broking account utilizing Interactive Broker. We run a number of model portfolios inside there where we can work with you to track the top 20, the top 50 or the top 100 ASX model, the S&P 100 in the US, or we have ASX High Conviction Model, which is a handful of stocks that are a combination of my fundamental analysis on the market combined with the technical signals to identify what I have a view of high conviction relative to other opportunities in the market. So it's a more concentrated portfolio, but it's a blend of technical and fundamentals. And we also do the same there on the US with the US high conviction portfolio. Within Interactive Broker, we can run a independent portfolio, which is where we can work in partnership with you and buy and sell shares specific to what you're interested in. And then within IB also we can utilize derivatives to enhance portfolio returns. If you'd like to know more about opening a global broking account with Investor Signals, if you go to the Investor Signals website, I'll just bring that into screen, and you're going to click on online broking, and within here register your interest. That takes you to a data collection form. Fill in your details there. That'll come back to my inbox. I can give you a call, discuss further about how the service works. We'll fill out all the paperwork for you and send it to you in the mail for you to review and sign where required. Or alternatively, if you just want to discuss the service prior to completing that form, please call me on 1300 614 002. All right, moving straight into into the top 50 stocks. We'll start with XJO, I think, and just comment broadly on what's going on in the market given the extent of the selling that we've seen in the first part of this year. My sense is that the coronavirus has probably had its peak impact for the time being on the market. Friday night in the US, we saw US leading officials comment about what seems to be a controlled, played down response in the US relative to what we saw a couple of weeks ago around sort of the uncertainty of data, if you like, out of China. I got some comfort from that. Further comfort came from the strong buying in the US going into the last hour of trading. And valuations are starting to look attractive. Obviously, the earnings picture remains a little bit cloudy and uncertain, and if you backtrack on that front, S&P 500 earnings were meant to grow 7% in 2020. At best, they're going to be flat. The next couple of quarters look like they'll probably go negative, but we're still in an environment where flat earnings growth is attractive relative to low bond yields. So I'm leaning towards early this week being a buying opportunity, and the purpose of today's recording is to help identify those and tie the timing in around the decision making with what we post on the blog. So keep an eye on those daily posts. So the Australian market, the base case is we're getting down to a level of support here. We're within a couple of percent of where both global markets find support, and we'd expect to see buying come back into the leading stocks. One of the lessons from volatility or periods of high volatility in the market is you really want to keep trying to tilt your portfolio towards the better quality names and identify defensive businesses that are getting oversold within the panic of the market. Money will flow back into these yield sensitive names, and as we go through the top 50 stock, we'll look to identify those. So from an algorithm perspective, I suspect that we'll see a buy signal on the XJO this week. On that, let's move into the top 50, starting with AGL. AGL's under sell conditions, so we can see the algo signal flag the exit there. The stock's since sold off from $21 down to $18. So we're not doing anything there in AGL at present. Aristocrat's just switched to buy conditions just last week. And I'm comfortable taking a look at Aristocrat growing earnings, probably somewhere in that sort of 15% range, and it's roughly on a 2% dividend yield. So between $30 and $32, Aristocrat's worth having to think about. Amcorp, I commented a lot on this last year. We're strong buyers of Amcorp at the lows there. Rallied from $13 up to $16. The Bemis acquisition, where they acquired the New York NYSE listed company, the latest earnings results came through showed that they were ahead of target on the cost synergies, but the underlying business was really only growing about 1 to 2%. So in an environment where global demand's softening in at least the March quarter and probably the June quarter as well, or at least the early part of the June quarter, it's hard to see Amcorp really earnings growing above what they presented in the last result. But we're comforted from the downside risk being cushioned from those cost synergies still coming through from that Bemis acquisition. So anywhere from sort of $13.50 to $14, I've marked out where I see value for Amcorp. But as we approach this week, I suspect that Amcorp will be a stock that starts to get buying interest. So keep that one in mind. AMP, it's switched to buy conditions at the moment, but it's not one that's in our high conviction portfolio. We'll continue to watch the short-term momentum indicators and look for those to turn higher, but it's been a long time since AMP's been under buy conditions. ANZ's under sell conditions, so we had the algo sell there at $27. It's sold off $5 down to $22. It's not in the model. APA Group, this is one that I really like. APA Group had a takeover bid from Hong Kong-based fund manager at, from memory, around $12.50 a share. It was knocked back. The Australian government blocked the transaction. The latest earnings results presented by APA showed underlying earnings growth of 7%. We've got the stock trading on about a 4.5% dividend yield. I can see it trading back above $12 this year, and the downside risk look relatively low to me. So that's a stock that I like within the top 50. Now the ASX, this hits our high conviction buy list now. The stock's corrected from $87 down to $74. Volatility in the market creates a short-term spike in transaction income. Obviously, the concern here is that the company was only growing earnings around 1 to 3%. If we had a major global recession, at some point that leads to less companies listing on the exchange, less transactions taking place. So it's certainly not a risk-free proposition, but buying ASX down here, given sort of my thoughts where support is likely to begin developing in the global indices, I think there's a pretty compelling buying opportunity here in ASX at these levels. AZJ, this sell-off's been deeper than I had expected. It's extending a little bit past sort of 50%. We're probably down to levels where it's going to find some support. I don't get excited about AZJ on a sort of 12 or 24 month earnings outlook. At best, they're going to deliver flat earnings. They're paying out 100% of their earnings in dividends. They are doing a share buyback, which will underpin the share price a little. Fair value for it's probably back up between that sort of 5 to 525. I don't know that in a hurry it trades back up to that 550. But as with many stocks in the market, we're getting down to levels where we're likely to see a recovery. BHP, so between $30 to $32, we have support for BHP, trading on about a 6% dividend yield at the moment. Iron ore prices actually have held up reasonably well in light of the global problems, trade problems that we're having. I'd expect iron ore prices to firm, which should help to underpin a turnaround in BHP. Likewise, oil prices at sub 40, they're trading roughly 41. Sub 40 would be an entry level into oil at the moment as well, which will support BHP. Brambles, so if we have a look at this, the company was one of the few industrial stocks that were delivering earnings growth around 5%. But again, in an environment where global trade slows, maybe that 5% becomes a bit questionable, and the stock was trading on a fairly high PE when it was up there at around $13 odd. It was compressed down to less than a 3% dividend yield. It's back at about 3.9 at the moment, so around that 11.50 level looks like a good entry point into Brambles. CBA was very expensive relative to its global peers. It's expensive relative to Australian banks, but Australian banks in general are expensive compared to the global banks. And for that reason, something to give thought to is the global bank ETF. And we'll cover that in the next Opportunities in Review webinar that we do separate to today's session. So in the case of CBA, between $70 and $75 is support. We're likely to see it find buying interest there, and the short-term indicators turn higher. So CBA's in our model after being short CBA over the past 3 to 4 months. Cochlear back on support there at around 200. Coles Group, so if you'd been following the blog, this was a strong high conviction buy at around $14. The stock's since rallied up to $15.70. $16 is about full value for Coles at the moment. Don't see it doing too much above that. Computershare, we'd been on the short side of this stock and it's sold off from 18 down to 13. The concern here with Computershare is that lower global interest rates impact their earnings, and at 20 odd times earnings and a 2.5% dividend yield, the stock was just too expensive. It's probably back at about fair value. We had a target on it around $12.50, and we're pretty much there at the moment, so getting close to support there. CSL continues to perform well and a very good momentum play within the algorithm portfolio. Caltex at around $32. You got a takeover bid up at around $35. So the stock should be well supported there. Dexus Group doing a large-scale share buyback underpins the downside risk for the stock. It's on about a 4.25% dividend yield. Fortescue, preference is Rio over Fortescue, but Fortescue at around $9. We saw Twiggy Forrest come into the market and buy almost $300 million worth of additional Fortescue shares. That's maybe a vote of confidence in the business, and as I was saying, iron ore prices have held up reasonably well. Goodman Group, so there's no doubt this is one of the better growth property trusts within the top 50, growing earnings at about 8%. You got exposure to sort of the logistics, online fulfillment centres globally, especially throughout Asia. So I think the growth story for Goodman remains in place, and you want to be a buyer on any dip within Goodman. GPT is just fair value at $5.90. We're seeing that earnings growth slip from 6% back down to about 1 to 2%. So it's really just an income trade. We're owning it here and selling at the money covered calls. You're driving about 10% cash flow from the dividend and the call option. Insurance Australia Group, the insurance names have all had their obvious issues over recent times. A number of analysts are starting to upgrade Insurance Australia Group with price targets of around $7.50. I've got the stock trading on just under a 4% dividend yield where it is at the moment, so upside target maybe $7.25 there in Insurance Australia. James Hardie's just switched to buy conditions, so we're seeing support there at around $27. Lendlease, I like this. This sits in our high conviction portfolio. They're now divested of the troubled engineering business. The long-term sort of runway that the company has, among other deals, one of the leading ones announced at the end of last year was a $21 billion development project with Alphabet, which is the Google parent in the US, building residential housing in the US. And I think that lends to the quality that Lendlease is, the projects that they're focusing on, outside of that engineering area in residential construction and urban development. So from an earnings perspective, I think Lendlease sits somewhere around that 5 to 8% earnings growth into 2020, which should support the stock at around that $17 level. Mirvac, a number of fund managers have a overweight position in Mirvac. It's not a stock that I'm particularly fond of. Lendlease over Mirvac's my preference, but just keep in mind that the fund managers are fairly bullish still on Mirvac. Medibank, the health insurers have had their woes. Medibank's probably the better quality of the two main leading health insurers, and at around $2.80, it seems to me that the stock's about fair value, but given where low interest rates are and the search for yield in the market, it wouldn't surprise me to see some buying come into Medibank and see it push back up to around $3. Macquarie, I think this is a buy on the dip. Anything around that 130 level is a good entry opportunity into Macquarie. NAB, we're not so keen on. Newcrest, this dip that we've had from $40 down to sort of $27 roughly, that's an accumulation point, and we've been speaking about that on the blog. Origin Energy, the whole energy spectrum, whether it's natural gas, oil prices, are both under significant selling pressure at the moment. But if we start to see the global growth picture pick up a little, as I anticipate, we're probably down at a level where Origin starts to find a little bit of buying support. But the company's struggling with their retail electricity side of it, managing costs and margins, and the area that's really delivering the growth is the LNG development at Curtis Island in Queensland. Most of that's all done under forward sales, so the short-term spot prices are not impacting it, but just generally sentiment towards these energy names. My preference is Origin and Santos over, say, Woodside or Oil Search at present. From a yield standpoint, as Origin has started to reinstate their dividend this year, we got Origin trading on about a 4.5% dividend yield, so quite an attractive yield within sort of comparison of some of the other energy names. Orica, so we saw Goldman Sachs do a placement here of $500 million. It was taken up, which I think goes to show some of the investor demand here in Orica. They made a large-scale acquisition in South America. The stock's retraced about 50% of its rally over the last 18 months, and I suspect that we're looking at support developing at around that $20 level there, $19-20. Oil search, keep away from this one. I think the better opportunity is Santos and Origin, as we discussed. Qantas. My preference for playing a global recovery would be in BHP, Rio, and Macquarie rather than Qantas. But you get a sense that sort of this selling within this tourism impacted, whether it's the hotels, airlines, uh, that we're getting down to a level where they're looking oversold, but it's hard to understand what the ultimate financial impact of this is and whether they need to do discounted capital raising to shore up their balance sheet, and for that reason you're better off gravitating back towards those companies like BHP and Rio, Macquarie, rather than sort of speculating on too much on sort of companies that may have a question mark over what they need to do to shore up their balance sheet. QBE back under buy conditions here at around $12. So within the insurance sector, we're starting to see a turnaround there in QBE, but again, low global interest rates doesn't sort of bode well for support for these insurance names. Ramsay Healthcare. Now, the earnings missed a little bit below market consensus or expectations, but back down at around this $65 level. Ramsay Healthcare's a buy, so add that one to your list. Rio Tinto at around $85. Comfortable with that. South 32, we're not doing there at present. Centre Group, not doing there. Stockland, not doing anything there. Sonic Healthcare, so this was one that at the same time that I gave the buy rec on Coles, we highlighted the buy opportunity here in Sonic on the blog. So again, 11 o'clock each morning, if you're signed up as a subscriber, you get the blog recommendations, which is not just 3 or 4 recommendations for the sake of it. It's really sort of focusing in on exactly what it is that we're buying in the market. So it might be reinforcing the same ideas from prior days or the prior week, but it's just trying to highlight to you what it is that we're taking action on in the market. Sonic Healthcare, earnings growth's only around 3% in this at the moment, and I've got it trading on a dividend yield of about just over 3%. I'd expect this to mostly trade sideways from where it is at the moment. It's pretty close to full value. Santos, as with Origin, getting pretty close to support and just looking for that turnaround in the energy stocks as we see some buying interest pick up in the global indices. Suncorp not doing there at the moment. It's under sell conditions there at 14, and you can see it's peeled away down to $11. Sydney Airport, so I like this as a recovery opportunity. So somewhere between this 7 to 750, I'd expect it starts to find support. Obviously, we just need to keep an eye on those headlines around the coronavirus, but at the moment we're and it needs to be reassessed on a daily basis, but we're really sort of starting to form a view that it looks like in America you're not going to have that same level of maybe drama, or negativity, or I get hysteria around what could potentially play out. I think Friday they seem to signal out of the Trump administration their view on it, and how, and to me I got a little bit of comfort that they were not taking the path of being alarmists about what may lie ahead, and I think it's fair to say that no one can have any certainty at the moment as to the clarity or surety around the data that's been presented around those that have been infected with the virus, and obviously what the fatality rate may be. But it appears that in America they're not making that out to be any worse than it may be. So on that basis, we're forming a view that there's going to be some buying step back into equity markets, and maybe the worst has passed from a headline risk around that. Transurban Group at around $15. This looks attractive. So owning it around here and selling covered calls makes sense to us. Telstra Corporation around 350, looks like it's finding support. Treasury Wines is under sell conditions, and we've avoided that. Maybe down at around these levels, it's starting to look cheap enough to think about, but we'll revisit that on the blog. Vicinity Centres under sell conditions, not doing it there. Westpac, again, my preference is to maybe look at that global bank ETF, but Westpac and CBA may be getting down to levels where you want to start thinking about them. Wesfarmers, we've had the correction from 47 down to 39. It's now switched to buy conditions. Somewhere around these levels, it starts to look good value to me. Wesfarmers on over a 4% dividend yield. So I think sort of 3 to 4, maybe 5% earnings growth across the conglomerate. 4% plus dividend yield, we should start to see buying interest pick up there in Wesfarmers. Woolworths at around 37 to 38, we're buyers of that. That's under algorithm buy conditions. Woodside's under sell conditions there, and it's fallen from 36 down to 26. And there we are back to the index. So my thinking is that over the course of this week, we'll see the algorithm engine switch to a buy condition here on the XJO. I'd anticipate that we're within a couple of percent of support building. We're keeping a close eye on the US market, thinking that we start to see buying build this week in the US. We're encouraged by the late buying in the S&P on Friday night, and that should set up opportunities within these sort of top 50 stocks as I've highlighted, and we can reassess that as on a daily basis as we see how the sort of global issues play out, both on the health side and obviously on the impact that has on company earnings. Thank you for listening in, and if you'd like to speak with me about the Investor Signals broking account service, please give me a call on 1300 614 002. Thank you.